There is a lot of traders that struggle to understand why the price is moving on the chart the way it moves. Because sometimes price create a trend and then it breaks that trend, maybe just a short while, and then goes again with the trend. Price create a structure and then kind of break its own structure and goes against that structure and then continues. So there is a three main reason for the price to move. Number one, and I'm going to say it in a simplistic way because most people need to understand first two. The price build liquidity. The number one goal, what price is doing, price is building liquidity or directing the traders to see the lines and channels that people can align with those channels and put their stops right below or above. Those stops becoming a liquidity. And after the price builds liquidity, then it's going to grab that liquidity and break those channels or those figures and collect liquidity. So there's only two main reasons that most people needs to know what price is doing on the chart is the price is building liquidity and grabbing liquidity. By understanding that, you will escape many traps that price is setting for the traders. And the third reason why price is moving on the chart, because price maker having its own objectives to achieve. For example, mitigate order blocks or fill in the gaps or finish unfinished business and complete the price cycle. To say it more correctly, actually the price is always going toward its goals and objective first and build and grab liquidity on a way to achieve those goals. So again, number one priority for the price is those unfinished business, those unmitigated order blocks, those gaps that is not filled yet, and those price cycles that needs to be completed. And on a way to achieve these objectives, price is always building liquidity and collecting that liquidity. When we're observing a channel structure that is very predictable, then we need to remember that every channel have a one reason to being built. Purpose to build a channel that the price would like to show every trader a very concrete line where the traders can enter again and again in both directions. So they entering, if they enter from downside, then their stop is sitting right here. If they entering from the upper side, then their stop is sitting right here. So there's a bunch of stops along this channel. And this is fancy way to say it is liquidity. So the stops sitting above and stops sitting below the channel. So we should expect that every channel must be broken. So we can continue this channel line and we can see that channel sometimes going in the upper side to grab this sitting liquidity on the left side. And then it may go and cross the lower side of the channel. And then it may try to find a support somewhere here or along with this line and then swing down. By moving down, the price collecting all of that liquidity sitting on the downside of this channel. So the channel builds only to put traders in a line where to enter into the long or into the short. And then the price will collect liquidity, probably on the left side, by going slightly higher, and then going dramatically lower. This flat structure is super dangerous to trade, especially if there is a previous historical top sitting somewhere like in another previous day or previous week. So this is the structure, flat structure, that builds equal tops and equal bottoms, and there is a bunch of liquidity collected at the both side of this structure, above and below. And additionally, There is some more liquidity sitting on a previous historical top. But when the price is going to reach the upper side of this liquidity, it will use that liquidity as a fuel to gain the speed on the way up, and then hitting previous historical top where some other liquidity is still sitting over there, it may accelerate even further and people may go long because they believe the price broke the significant structure. But indeed, quite often the structure will reverse, the price will go and collect liquidity on the opposite side of this structure at the bottom side. And so when we see a narrowing triangle, what we have in mind? We may be thinking about that the price will release toward the main direction that's going up, or maybe it will release in a way down. Reality shows that the reason why the price built this narrowing triangle is because there's liquidity built above and below. And the goal for the price, collect all of that liquidity by going to the very lower point and by going to the highest point. So all of that liquidity that sits over here, and below over here will be taking. But sometimes price may go slightly lower, like maybe a 50% or 30%, and grab only liquidity that sits over here, some partial liquidity, not completely going down and grabbing the liquidity that sits below this lowest point. Then, by going like a 30 or 50%, price reverse and going into the opposite direction and maybe not going completely again. It may cover only, let's say, 50% of the liquidity that sits over here, and then price may go and grab the rest of the liquidity that sits over here. Then reverse again and grab the all liquidity that sits on the top of this triangle, and of course all of this internal liquidity. So the price may go up and down several times, and making traps for the people who trade in one direction or another direction.